Whether you're dreaming of a retirement with sand between your toes and a cold one in your hand, hitting the road to chase the winds of adventure, or spending time with your grandchildren, this show is intended to help you get there. Welcome to Coasting in Retirement with your host, Josh Knoll. You've worked too hard throughout your career to spend your retirement worrying. So sit back, kick up your feet, because we've got lots of financial tips and tricks to share to help you get exactly where you want to be. Here's Josh.
Good afternoon, everyone. Welcome to Coasting in Retirement. That's right. Thanks for joining us today. We're excited to have you. I'm your host, Josh Knoll, alongside co-host Michelle Lee Melton. Back in studio. How you feel, Michelle?
I feel pretty great, all things considered.
That's great. Okay. Well, we're glad to have you back. So here we are, Michelle and I, once again in Coastal College's recording studio, beautiful downtown Fairhope, hatching up another great show for those of you tuning in. So listeners, Michelle and I are here today to discuss financial topics relevant to those of you in or near retirement, living your best life here along our part of the Gulf Coast.
Third Coast.
The Third Coast, yeah. If you're just tuning into the show, welcome. You're listening to what we consider Lower Alabama's most dynamic financial radio show. Here's what we got in store for you today. First segment, deep dive on our topic of the day. Second segment, about 20 minutes past the hour, fan favorite, Michelle with the news of the week.
Nice.
Third segment, roughly 40 minutes past the hour, Josh's crystal ball and...
Big mouth.
That's right, big mouth. So buckle up. We got a lot to get to. Now, quick background again on for those of you new to the show. My name is Josh Knoll. I'm a fee-based financial advisor. I hold my FINRA Series 65 securities license, and I'm the owner of Gulf Coast Financial Advisors. That's an independent investment management and financial planning firm. We have offices in Fairhope and Orange Beach. You can find more information on me and Gulf Coast Financial Advisors by visiting our website, gulfcoastfa.com, or feel free to always give us a call at 251-327-2124. Now, if you just missed that, don't worry. We'll repeat our contact info several times throughout the show. Now, listeners, every now and then we have a topic that we just can't fit into one episode, and that's going to be the case today. So it's also double header, right? So we welcome you to what we're calling part one of a two-part series where we tackle what is happening. Well, first, let's back up, Michelle. October. It's October.
It is spooky season. Yes.
Spooky season. So we're going to talk about a spooky topic for a lot of investors. Folks, today we're going to be talking about the bond market in part one. Part two, we're going to talk about the bond market, bond yields, things like that, and its broader impact on the likelihood of a recession. Interest rates, bond yields, things like that. We'll kick this part off with a discussion about bonds and bond yields, something that unfortunately has been all over the news lately. And even though it's been all over the news, I still think it's a topic that a lot of people don't fully understand. And to be honest with you, listeners, including a lot of people in my industry.
That's right.
Yeah, I mean, it even confuses me at times, and this is what I do for a living. But savvy listeners, you'll recognize bond yields as a way to kind of segue to some news, relevant news lately. It's called the inverted yield curve, which historically is a leading indicator of a looming recession. And that's, again, that we're going to touch on that today. We're going to set the foundation part one, and then we're going to talk about what this means into the broader economy in our next episode. So we invite you, tune in today, and then make sure you catch us next time. So, Michelle, investors that read financial news have undoubtedly noticed recent headlines like bond yields hit multi-decade high, or the bond yield curve is inverted, which means a recession is on its way. Now, why should those of you in or near retirement pay attention to bond yields? That's a fundamental question, right?
Yes.
We're going to attempt to answer this question, but first we're going to start with a little backstory and add some context to the basic math of bond yields. Let's start with this. Let's start by defining bonds and how they differ from equities. Very simply put, a bond is a debt instrument issued by either a governmental institution or corporations to raise money for something that they want to invest in. For example, if you buy a bond, you are loaning these institutions a set amount of money at a set coupon rate, which is a fancy way of saying interest promised to you, right? Interest promised to you in return for your loan for a set period of time, which is called duration, or taking it to bond maturity, if you will. And to start off, Michelle, have you had any experience? You have experience with municipal bonds, correct?
I sure do, Josh.
What do you have just one example of why a city would have issued a municipal bond?
To create a sewer and stormwater system or to upgrade one.
Perfect, right?
Big ticket infrastructure items.
So they issued the bonds. They offered a certain amount of interest. The regular retail investors and probably some institutional investors bought these bonds and hopefully they held them to maturity. That was kind of that's the normal way of doing things.
Yes.
Now, as compared to equities, bonds are not a piece of ownership in the underlying company or government institution. If you want to own a piece of, for example, Apple Inc., you buy a share of stock in them.
Yes.
If you want to loan money to Apple Inc., in exchange for some interest, you buy a bond issued by them. Got it?
Got it.
Good. Okay. Now, listeners, there are a couple other terms I want you to remember when it comes to bonds. First is face value. That's also known as par value, which is the amount the bond is worth when it's issued. For the record, most bonds are issued at a face value of $1,000.
I did not know that.
There you go. Next is the coupon rate, which we told you earlier is what is the interest paid on the bond. Now, these two things usually don't change after the bond is issued. Both coupon and par terms don't change much across the bond market. In that, what I mean by that is what you see in writing is what you are to expect. What does change, and the reason for this episode, is yield and price. Yield is a measure of interest that takes into account
Measure?
Yeah, Missouri here. Yield is a measure of interest that takes into account a bond's fluctuating value. So hold on a sec, Josh. I thought you said that most bonds' face value
You did say that.
I did. That is correct. The face value is usually is $1,000, but bonds can vary in price or their current value on the secondary market, if you will, which is what the bond would sell on that secondary market after it's been issued. It's really the last of these two terms, price and yield, that are the reason a normally boring topic such as bonds are all over the news lately. Why is that? Well, let's get into our history lesson.
Ooh, I like history.
All right. Plus, we're going to have a little silly example to explain.
Okay.
So historically, bond money is referred to as smart money when compared to equities.
All right.
But what do I mean by that? The thinking that is that savvy investors and traders sometimes prefer the certainty of the interest paid on bonds, that bonds help remove some of the volatility in your investment portfolio. And if the underlying issuer, generally speaking, a corporation, not governmental institutions can't get in trouble. Municipalities, cities can get in trouble. But typically, if a bond gets in trouble, more often than not, it's related to a corporation. When they do get into financial trouble, bondholders stand in line ahead of stockholders for repayment of capital. Okay.
Okay.
So let's take that statement piece by piece so that you investors understand why. What has historically been a pretty steady Eddie market, if you will, not only experienced its worst year ever. Since Napoleon, we determined
we did. We talked about Napoleon the tortoise, Jonathan.
That's right. It's worst year ever in 2022, and why it's still currently front and center in so many financial news stories. First, volatility, Michelle's favorite word.
It is. It's super hard to say, but fun.
It's one of the of all the three-syllable words I struggle with, that's one I can spit out.
I want to say vitality all the time.
Well, yeah, I have vitality when I'm saying volatility. It's how much an investment fluctuates in value. Historically, bond values. Remember, prices are set on the secondary market. Historically, bond prices or values do not fluctuate much because interest rates set by the Fed tend to be pretty stable. Now, unless you've been living under a rock, you all know that interest rates have not been steady lately.
No.
In fact, we've experienced one of
up.
the fastest rate hikes in our economy's history. So, okay, Josh, so why does that lead to volatility in bond prices? Let's pivot back to yield and price with a fun example.
Yay, fun.
Here we go. All right, so Michelle.
Yes.
I'm a corporation.
Okay.
Call me Josh Inc.
Ooh, all right.
Okay.
That's hot.
And I want to invest in a boat because I think it will improve not a sewer line. I want to invest in a boat because I think it will improve the bottom line of my company's revenue. So I issue Josh Inc. bonds and I sell you a bond for $1,000.
Okay.
In exchange, I promise to pay you 3% interest over 5 years. Okay.
All right.
Sound good?
Sounds all right.
All right. Now, so let's fast forward 3 months. In this example, interest rates have risen.
Okay.
And so I can't find any more suckers to finance my boat at 3% interest. So I started issuing new bonds at a 6% coupon rate, interest rate. So now here you are, you're sitting on the Josh Inc. boat. You're stewing about your measly 3% interest you've been receiving.
I have a tan, though.
Well, you got all these party goers around you on the Josh Inc. boat. Now they're getting 6%. So you get stewed. You get so stewed that you decide that you want to sell your Josh Inc. bonds and move on. Well, what has happened to the price of your bond? Is it still worth $1,000?
Probably not.
That's right. It's no longer worth $1,000 because there are better options out there offering higher interest, right? So just for this example, let's say the price of your bond has fallen to $975. That means
not terrible.
Well, okay, let's say it fell to 950, right? Now add some zeros after that, and you'll kind of see the pain, right? That means if you want to sell your bond, you're selling it at what is called a discount. And as a result, when you sell at a discount, your yield increases because yield moves inversely with bond prices, right? Or in other words, the higher the interest offerings go on new bonds, the higher the yields get on the overall bond market because investors demand more yield when buying lower interest paying bonds. Got it?
Boom.
So in this silly example, what happened to bondholders, or what happened to the Josh Inc. bondholders, is what happened to bondholders all across the bond market. Rapidly increasing interest rates resulted in discounted bonds, particularly hitting long-term bonds locked in low interest rates, or now low interest rates, resulting in a high yielding environment. And for existing bondholders that want or need to get out of their discounted bonds, this sucks because that's what's causing all the commotion among bonds, okay? Now, if this were the only issue bondholders were dealing with, it would be one thing. It probably wouldn't be an issue that was all over the news and leading many people to forecast a recession. But there's something else at play. So remember when I mentioned an inverted yield curve at the beginning of the show, Michelle?
Yes, as an indicator of something.
Well, you've heard that term. Any investor that's paid attention has heard that term before, inverted yield curve. So what that means, simply put, an inverted yield curve is when short-term bonds have a higher yield than long-term bonds. It means that, okay, so what I mean is a 1 year, 2 year treasury in this example has a higher yield than long-term bonds. What does that mean? It means that investors plan on earning less on bonds they hold for a longer term, which means investors at the whole think the economy is heading south. And at some point, the Fed will have cut rates. What's led to this? All right,
You're going to tell us.
100%. For the last, call it 18 months, or ever since the Fed started raising rates, I think back in March of 2022.
I think that sounds right.
Yeah, the 2-year bond yield has been a fairly accurate in predicting where the Fed was heading with rate increases. The Fed kind of played along with what the short-term bond market thought was going to happen with interest rates. It was actually reasonably accurate. The problem and the reason for the inverted yield curve is that the long end, or what investors refer to as the long tail, the long end of bond rates had to be dragged along. In this example, 20 to 30-year treasuries, even 10-year treasuries, lagged behind the short-term bonds. Now, normally, short-term bonds should not be significantly higher than long-term rates, okay? And when they get there, that's when you get the inverted yield curve. That means that as a general rule, investors have a pessimistic view of the economy in the long run. Now, fortunately, the curve's normalized a little bit here because long-term bond rates have caught up. But what does that do? That causes further damage to investors' bond holdings. And in general, what we're seeing is a general flight from equities to relatively higher interest, short-term debt instruments, such as shorter-term bonds, money market funds, and the such, right? Plain English, right?
Okay.
High rates are causing turmoil in certain areas of the market. For example, if you can buy a 6-month T-bill yielding north of 5%, why would you buy a utility stock only yielding 3%, right?
Right.
Remember the Josh Inc. bond example?
Yes, the boat.
Investors are opting for high rates with lower volatility. What does this mean for retail investors? Well, for long-term bondholders, it means that you have felt as much price pain as you've probably ever experienced in your investing career. Yeah, for those of you with a heavy bond portfolio, I will tell you, we do have at Gulf Coast Financial Advisors, we do have systems and softwares where we can do, I get
an MRI light?
Yeah, an MRI, X-ray, if you will. It's
nice.
the best way to describe it.
They are very revealing.
Yes, we can do that on your positions, and we can possibly talk to you about a game plan related to that. So here's the thing. There's no magic formula that's going to predict stock prices. So when we look at these things with the inverted yield curve, when we look at the higher interest rate, the higher coupon rate on newer bonds, there's no magic thing. Otherwise, all of us would be Warren Buffett's, and who the heck would know how this would shake out. But there is one thing that's heavily correlated. The relationship, You're right, the relationship between starting yields of a bond portfolio and the future returns are very correlated. Okay, again, plain English. It means that if your starting yields for a long duration bond are around 5%, there is an extremely mathematical high chance that your returns over a 10-year period will be around 5% or more, okay? But it's been shown that starting yields dictate forward returns to a large degree. So Again, what's that mean for retail investors?
What does it mean?
It means
Josh?
a 60-40 portfolio makes as much sense right now as it ever has, or it has for a long time. For example, if you buy into a mixed portfolio with long-term treasuries sitting at 4.5%, there's a mathematical high likelihood that your total return will be around 4.5% or greater over a 10-year period. It's not exact. It's just a likelihood, right? So contrast this with a few years ago where you bought bonds to decrease volatility, which was thrown out the window in 2022. But in exchange for that, you had returns that were almost nothing, okay?
Okay.
So listeners, I think it's important you understand the math behind what's happening with your portfolio. And, as we've said many times on the show, there's absolutely nothing wrong with those of you all that do the DIY, the do-it-yourself approach. But I will say that, this stuff is obviously in our blood. I'm a math nerd. Who else sits there and talks on the radio but bond yields?
That's right.
And we feel
Coupons.
and coupon rates and things like that. We feel at Gulf Coast Financial Advisors, we provide good value for helping you navigate some of these issues as it relates to your financial goals and dreams. So on that note, if you want to have a no-pressure, free, no-obligation conversation with us, why don't you reach out to us? You can catch us on our website at gulfcoastfa.com. That is GULF, like the Gulf of Mexico, Coast. FA is in financialadvisor.com. Upper right-hand corner, there is a link to my calendar. You can get on there and you set up, just a really low, no-pressure conversation. Or you can always call us, 251-327-2124. All right, so in summary, Michelle, did everything I say there make sense?
Crystal clear.
Crystal clear. So bond yields, the reason they're in the news is because the short-term yields the yields on short-term bonds were higher than the yields on long-term bonds.
Okay.
Why is that? Because interest rates rose rapidly.
Yes.
Short-term bonds, the ones are at 3%. Now there's 5-6% offering. So the price for those bonds decreased. That resulted in higher yield. And the reason the curve got inverted is because the long-term market, the 10, 20, 30-year treasuries and the long-term bonds, failed to keep up in a timely fashion. Okay. Now we're seeing a gigantic reset. We'll see how that goes. Keep paying attention to news. But yeah, anybody that pays attention to investments knows they have seen a lot about bonds and yields and interest rates recently, more than they probably have in the last 20 years. All right, so folks, coming up next, every week Michelle and I scour what she calls the interwebs for helpful financial articles related to our topic of the day, especially articles that pertain to those of you in or near retirement. So why don't you join us after the break to hear Michelle and I discuss this week's relevant headlines with our Michelle with the News of the Week segment. Stay tuned. Whether it's building a business from scratch with your own two hands and wanting to maximize the financial impact of those sacrifices, or growing a great nest egg by being a dedicated and reliable worker for years, or choosing to live a life well within your means in order to accomplish a lifelong dream of retirement, the last thing you want is to go with the wrong financial advice after you've worked so hard to accumulate your assets. You've also probably spent most of your life putting others' needs ahead of your own, and now it's your turn. We can help. Gulf Coast Financial Advisors is a locally owned, independent, fee-based financial planning, investment management, and tax planning practice. We have offices in Fairhope and Orange Beach. We serve all of Baldwin County and the Gulf Coast. We also have an easy-to-understand fee-for-service model with no sales quotas, no proprietary products. Our ultimate responsibility is to our clients' goals and dreams. You can reach us at 251-327-2124 or find us online at gulfcoastfa.com. That's GULF, like the Gulf of Mexico, Coast, FA is in financialadvisor.com. All right, welcome back to Co-Sustaining Retirement. Your host, Josh Knoll here. So as we discussed before the break, every week Michelle and I scour what she calls the interwebs for helpful financial articles related to our topic of the day, especially articles that pertain to those of you in or near retirement. Our job, or at least we think it is to help you all understand how these headlines impact you, especially when it comes to your money. So without further ado, here's Michelle with the news of the week.
All right, Josh, let's start with Yahoo Finance. They have a recent headline titled, "The 5% bond market means pain is headed everyone's way." This article gave me pain just reading it. It's actually really long, not encouraging except for about jobs. But anyway, first it talked about how 30-year Treasury bond yields punched through 5% this past week for the first time since 2007, and why the Treasury bond yield impacts everything from car loans to mortgages to cost of public borrowing. It also quoted analysis that compared what is happening to the bond market to the dot-com bust. That's a blast from the past.
That's right.
Early aughts. Saying that the bond investors are going to have to accept that we're not going to back what was true in the last 10 years.
Right.
Yeah, okay. Of cheap money. And I mostly stayed awake during your explanation of bond yields in the first segment, mostly. However, can you please tell me how much pain we actually have headed our way because of high yield bonds?
Well, okay, so first, who knows? But we can look at history to some degree. So when Michelle says history of cheap money or low interest money, anybody realizes that the interest rates were held, some would argue, artificially low for a long period of time. Well, what does that do? That stimulates growth. We saw, probably the greatest rise of the tech industry over a 10 to 15 year period that's ever happened in our economy because they were able to borrow money and issue bonds and things like that at a very cheap rate. Money was cheap. They turned around and invested in that. They had time. Many companies, such as Amazon, went years without a profit because
it's hard to imagine.
Yeah, right. Because they could. The money was cheap. They were paying low interest. They were able to invest it in growth, and off they went. Well, what's happened since the interest rates have risen? Well, now borrowing is expensive. It also, when yields get high, when investors get spooked, generally speaking, what it does, it takes away or eats away at the margin of recovery that you can get. What do I mean by that? What we've experienced, Michelle, in our adult lives, if you will, maybe going all the way back into the 80s, and we'll talk about this with Alan Greenspan, but generally speaking, what we've seen is the Fed on whole has, ever since Greenspan, had a strategy, if you will, of coming in and dropping interest rates down when it wanted to support and or boost the stock market. Again, go back to what I just said about cheap money. Well, we've currently got a Fed chairman, right or wrong, that really does not have, from what we've seen, doesn't have any interest in, he's not concerned about the stock market, okay? So what does that mean? He's completely comfortable with, he's solely focused on inflation. I don't disagree with that focus. Obviously, inflation touched everybody, all economic classes, up, down, you and I, me with 3 kids, all that stuff. It touched all facets of our lives. The problem with being solely focused on inflation, the thing that I've always said is everybody keeps talking about this magic number of 2% inflation. We may not have that for a long time, okay? Well, in the interim, while we're trying to get to this magic number of 2%, that means we're going to keep rates higher for longer. Well, what's happened by keeping rates higher for longer? First, because we have all been conditioned as investors and consumers that the Fed would come to the rescue with lower rates if anything got shaky. Now, and that's why the long-term bond market, the rates lagged the short-term bond market, inverted yield curve. Right?
There we go.
There we go. Investors are starting to catch up to realize that, oh my gosh, that means that we're going to have these higher rates for longer, and that what generally speaking means they have a little bit more pessimistic view on the long-term condition of the economy, what's going to happen in 2024 and beyond, right? So what it does with this, with higher yields, higher interest rates, it means that companies get squeezed. You don't see as much investment in the economy. You see a flight from, what we call flight to safety, which we'll touch on again here in a little bit, where people might get out of the equity market, particularly with a lot of the volatility that we see. They start getting into more fixed interest investments. They start getting into more fixed income investments. And overall, what it does is it can hamper growth. Now, it's great for the lenders. It's great for the bondholders, the new bondholders. Okay. If you've got bonds that you held, municipal bonds that were a low interest rate, it doesn't feel so great right now because you're seeing a pretty damaged position. But if you're coming into, again, reference to the classic 60-40 strategy, and you're buying newer bonds, you're seeing really attractive interest rates. You're feeling pretty good about it as long as your equity part will just play ball. The question's going to be, and the reason that they keep talking about recession, we're not going to go into recession because bonds bottom out. Because if we had, we would have bottomed out in 2022.
Okay.
Recession, generally speaking, is going to be tied to the equity market and what people think about the future of companies' profitability, companies' growth, private economy, the things that we really invest in America. Right now, we're at a really fragile tipping point on what investors are thinking long term about that part of it. again, that's why you're seeing a flight to safety. So great article, Yahoo Finance.
All right, so next up, CNN Business fills us in on here's why investors are selling bonds in droves. This article reinforces a topic we've discussed on the show, that bond prices cratered in 2022 after the Fed began drastically raising near zero rates to tame runaway inflation, which triggered a steep sell-off in bonds, which I now understand resulted in a lower discounted price for bonds and higher yield. So this article also quoted a bond analyst. I can't say that today. There you go. Thank you
volatility analyst?
Yes, thank you for that. As saying that, quote, next year you're going to have to think about fundamentals that are going to support a larger allocation to fixed income, end quote. All right, Josh, what's this mean in plain English, and what are your overall thoughts on this article?
All right, so first, what have we seen in the equity market in 2023? What we saw was kind of a surprising resiliency. That's a word I can't have our charge saying.
Woo, I'm telling you.
Yeah, so we've seen a surprising strength in the market up until recently. 2023 was, scratch and claw, but there were some gains to be made. And then all of a sudden, within a week, call it 10 trading days, most of the gains were given up for 2023. So why is that? Because investors have started to sour a little bit on some of the, especially institutional investors, are starting to sour a little bit on the high yields that we're seeing. So as stocks have declined, bond yields have soared, bond prices, remember, there's an inverse relationship between yield and bond prices. When bond prices go down, yields go up. So bond prices have tanked. That's caused pain for investors because, again, we've all been conditioned as investors. Anybody that's been an investor since, call it the mid-'80s, if you will, we always bet that the Fed would curtail its rate hiking campaign to come bail out the stock market. We're not seeing that.
Not happening.
And we're not seeing any indication that that's going to be the case. So what does that mean? That means that it causes, with higher rates, it causes weaker growth. It causes across the spectrum. The Fed just recently even signaled it's going to raise rates one more time this year. It is hunting that inflation, inflation animal, if you will. And it doesn't help, too, that there's been a flurry of new government issued debt that's basically inundated the bond market. So that pushes prices down, too. So what we are seeing, it's not the first time, it won't be the last time, but what we're seeing is this uncomfortableness, this high yield, bond prices going down. We've seen it have an inordinate effect on the overall stock market because it is causing shakiness, and it's definitely seeming to ding investors' optimism. Now, on the flip side of that, if you're a borrower, this sucks. If you're looking for a house, looking for a car loan,
getting a loan.
If you're looking at building an addition on a house and the bank's quoting you 10%.
That's right.
I've told the story in the show before. I remember when I was very young in the early 80s, my dad came home, got a construction loan on a house, and for the life of me, I think it was either 14 or 16%. Whatever it was absurd. Well, guess what? We're starting to creep back up towards that. Right? And so the thing is, okay, can we beat inflation right now, but at what cost? So that's why investors are selling bonds in droves. They're losing a little bit of optimism related to the overall economy. They're starting to accept the fact, and I guess I'll give the Fed credit. They've been very consistent in their message. They've told us all along. We just didn't believe them. Honestly, we just didn't believe them. When they told us they're going to keep rates high for a longer period, we thought, they're just saying that so people will quit overpaying for commodities and things like that. That hadn't been the case. He was telling us the truth. Rates are going to be high for a long time. So on a positive note, that means if you're looking for, if you're on the flip side of that and you got cash, man, you got options. You got money market funds paying mid-5s.
That mattress money.
I just looked at a MIGA today that's American base. It's 5.75 on a 5 or 6 year. There's some offshore stuff that's a little higher. I don't do offshore stuff, but your bank CDs have gone. I mean, everything. Yeah, we'll talk a little bit more about that in the next article. But yeah, if you're someone sitting there with cash and you're worried about the stock market, you've got options now. You've got really attractive.
It's nice to have options.
You have attractive interest options. Whereas rewind a year ago, 18 months ago for sure, you didn't have those options. So yeah, that's why investors are selling bonds in droves. All right, what's next?
All right, next is Reuters. Yeah, okay. I think where you live makes it different. Okay. But anyway, look. So this one is actually another joyful headline for our listeners.
Well, it's
it
October.
Just keeps on coming. And it reads, Bear, as in the animal, steepening U.S. yield curve dashes soft landing hopes. I will say that despite the less than encouraging headline, this article does state that from an economic perspective, there's a certain irony at play. Long-dated yields are soaring partly because incoming data suggests the economy is far more resilient, Josh, than most observers, including the Federal Reserve policymakers, had actually expected.
Right.
Which was actually mentioned in some of these other Buzzkill articles. So, but this article also references a deteriorating U.S. fiscal picture. Rising new debt issuance and investors demanding a higher term premium on long-term debt as factors leading to the inverted yield curve. So, Josh, what exactly do they mean when they say soft landing?
Right.
Because that sounds a lot better than a crash landing.
Right.
But I think I have an idea of what a crash landing is equivalent to based on this show today.
Right.
Okay. And also, what is your opinion on where we are headed based on all of this information?
Okay.
And I'm scared.
Well, don't be. We'll make it through this. Again, it's on when you trade off one thing of the side of the investment equation, generally speaking, you have the ability to flip to the other side and try to balance those two, which is exactly what the Fed has tried to do in the history of the U.S. economy. I would argue, rarely have we had a soft landing. You know, usually what we've seen is, especially over the last, call it 20, 25 years, you've seen a boom followed by a bust. .com, you referenced that earlier, housing market crash. You know, usually what happens is people get a little overexcited, fear of missing out. They come late to the party. They dump too much money into a particular part of the economy. That thing busts and it ripples out across the broader economy, particularly with the housing market. So when they say soft landing, what they hoped was they could raise rates, get inflation down quickly, not have a huge impact on the economy, on hiring, on investments, things like that. What's throwing them off is the fact that as somebody our age, Michelle, we're what are we, mid-age? What do you call that? When you're midlife? Are we midlife?
We're midlife, sadly.
Yeah, we're midlife, right? When you're midlife,
I don't
and you
feel like that.
Well, no, but you look around and you get these job reports numbers, and some of our listeners right now are shaking their heads. You get all these job report numbers where all these jobs are being created, and you look around. No offense, young people, that the handful that are listening to the show, but you're like, where the heck are all these people working? Because because I don't see them working that hard. You know,
they're influencers.
They sound like get off my yard guy here, but the point being is, the jobs data keeps catching the Fed by surprise to some degree because it keeps going strong. It was almost triple. The report was almost triple last time what they were expecting. Also, the consumer, the buying consumer, has stayed resilient. They keep buying things. We keep buying our iPhones and our cars and all that, right? So what that does is that it's one of those things. It's a double-edged sword where, yes, it's good. Companies are still making products. People are still buying products. Companies are still hiring people. People are still working, at least somewhere they're working. But what that does is that's keeping inflation, again, I would argue 2% is a little bit of a fairy tale, but it's keeping higher than what the Fed is shooting for.
I'm ready for that fairy tale.
Which is damaging their ability to, quote unquote, have a soft landing. At some point, for example, I don't know what the magic number is. I've seen various reports, but somewhere in the high 7s or low 8s is when mathematically it's supposed to have a very severe effect on the housing market.
Correct.
Okay. Well, again, if they were looking at slowing down a particular piece of the market and they just wanted to, as a tail effect, have mortgage rates go high, and then that really damps down construction, which is a big part of our economy, then you would say, okay, they're having an effect. The problem is there's not enough supply. There's still more demand than supply.
Yeah.
So you got these things all out of whack, right?
That's correct.
So, and that's why it says there's certain irony at play with this. It's going to be, I don't know how they thread the needle. All I know that is if you're on the investment standpoint, and again, this show is dedicated to those of you in or near retirement, I want you to take a deep breath. If it's going to be hard to judge equities in a broad sense in the short term, because remember, your equities in general should always be in a long-term position. That's their job. But if it's going to be hard to judge equities in a short term in your particular financial situation, well, on the flip side of that, now you've got stuff on the bond side, on the fixed income side, that is offering as attractive interest rates as you have seen in 20 plus years. So there's a little bit of give and take, right? Now for borrowers, again, this sucks. But for those of you who enter your retirement, if you're still looking to borrow money, I'm sorry, it's not a great time to borrow money. But if you're looking at being on the lending side of that, where you're lending to companies or municipalities or to the government in the form of a bond, if you're looking at parking money in something that gives a guaranteed interest rate, there's no such thing as no risk on these things, but they definitely are considered less risky than equity position. Well, now you got some options, and we can help with that. 251-327-2124. We got time for one more?
Yes. So, last article, which is actually more like a white paper than a news article, but the source comes from the Municipal Securities Rulemaking Board, which I learned is a United States-based self-regulatory financial organization that writes investor protection rules and other rules regulating broker-dealers and banks in the municipal securities market. It's a lot of words there. Long sentence.
It's a pretty in-depth little white paper.
Yeah, it sounds interesting, though, since I work for a municipality. Anyway, I might have to look into it more. So they have a downloadable white paper simply titled What to Expect When Selling Municipal Bonds Before Maturity.
Okay.
But this 4-page article -- white paper appears to have a lot of great info, including many things we touched on in this episode. So I read the whole thing, and I did catch, this is at the end, a section titled Tax Implications of Selling Your Bond Before Maturity. And Josh, I think you have discussed this recently, so the floor is yours if you would care to enhance this.
Well, so a couple things. This was released by the organization Municipal Securities Rulemaking Board, so it's not a private, or maybe it's a public-private partnership, but I feel comfortable of saying that. Listeners, if you want to get a copy of this white paper, just shoot us a message on our website, gulfcoastfa.com, or give us a call at 251-327-2124, particularly those of you listening that have a heavy municipal bond position. It's really well put together. I didn't write it. I don't necessarily endorse or anything like that. I just know it comes from a respected organization that deals with making the rules around municipal bonds. So I would trust the info.
Sounds like a good source.
It seems like a good source. Thank you. So now here's the thing. Why are we talking about municipal bonds so specifically? Think about it this way. When you look at bonds, you're giving money to an organization in exchange for a guaranteed interest rate. All right. The more secure or stable the organization that you are lending this money to, generally speaking, means that they would pay less interest.
Okay.
What do I mean by that? If you buy U.S. Treasuries, which are considered
that's like the gold. That's the golden thing, right?
It's considered if not the safest, I think it's probably considered the safest security in the world, right? It's where foreign governments park their money in U.S. securities, right? Now go down the chain a little bit. Now we're going to look at state-issued bonds. Well, states, generally speaking, don't go bankrupt. Maybe it happened back in the Civil War.
Michigan.
But it's been a long time, right? All right. So they're going to offer, but even though they are super secure, they're going to be considered a little less secure than the federal government. They're going to offer a little bit higher interest rate. Now keep going down the chain. Municipal bonds, cities, they're going to be, again, relatively pretty secure for the most part, or at least historically, cities do go bankrupt. But they're going to have to offer a little bit higher interest rate compared to the state or the Fed. And then you got the corporate bonds, which can be investment grade or what's called high yield, often referred to as junk bonds. Those are going to offer more. So reason that they talk about selling municipal bonds for maturity is because a lot of investors, particularly high income investors, municipal bonds are one of the few places where you can get tax-free interest.
All right. Sounds good.
Usually if you make a high income, you're not eligible for a Roth.
That's right.
Right? So you don't have tax-free growth there. Municipal bonds are one way for high income folks to park money in and get some tax-free treatment, which at their high income, usually they're precluded from doing in almost any other investment choices that you can get. So that means that municipal bonds, generally speaking, can be a very popular choice for folks that are in or near retirement. Okay, that's great. But now you got a bunch of municipal bonds that were priced, long-term bonds that are priced at a low interest rate compared to current interest rates. And now you're looking at your bond portfolio and it's underwater. It's showing a loss.
Ruh-roh.
Sometimes a significant loss. And you're like, what the heck? I thought I bought something that didn't vary much in value. Well, again, remember, interest rates go up, prices go down, yields increase. And consequently, now you have people looking at getting out of municipal bonds because they're worried that this high interest rate environment is going to be around for a long time, and these bonds are these already damaged municipal bonds from a price standpoint
beat up
are just going to get worse.
Oh,
which is what happens as interest rates go high. Your bond position is not going to magically improve.
That's right.
We can help with that. We do have systems and softwares to help you look at that. It's actually pretty sophisticated. We've done these analysis. It'll give you, it's kind of like sitting down with a doctor.
An aneurysm?
No, I won't give you an aneurysm, but sitting down with a doctor and finding out exactly, hey, here's what you got, here's the diagnosis, and here's what we can do about it. So 251-327-2124. All right, Michelle, great job with the headlines as always.
Right.
Important pieces of information, especially for those of you in or near retirement. So listeners, again, if you have questions around these topics in our headlines, or you just have questions around your investment strategy or your financial plan, you can set an appointment by calling 251-327-2124, or you go to our website, gulfcoastfa.com, Gulf like the Gulf of Mexico, Coast, FA is in financialadvisor.com. Upper right-hand corner, you can click on our calendar link, set an appointment there. No pressure. It's free. No obligation. I'm an easygoing guy. All right. All right, folks. Coming up next, Josh's crystal ball and big mouth.
That's right.
What have been some of my predictions? Have I been right? Was I ever wrong?
Sometimes.
How wrong? What do I think is going to affect investors in the near future, maybe the distant future? We can talk about all these things and poke a little fun at my big mouth. Stay tuned. Whether it's building a business from scratch with your own two hands and wanting to maximize the financial impact of those sacrifices, or growing a great nest egg by being a dedicated and reliable worker for years, or choosing to live a life well within your means in order to accomplish a lifelong dream of retirement, the last thing you want is to go with the wrong financial advice after you've worked so hard to accumulate your assets. You've also probably spent most of your life putting others' needs ahead of your own, and now it's your turn. We can help. Gulf Coast Financial Advisors is a locally owned, independent, fee-based financial planning, investment management, and tax planning practice. We have offices in Fairhope and Orange Beach. We serve all of Baldwin County and the Gulf Coast. We also have an easy-to-understand fee-for-service model with no sales quotas, no proprietary products. Our ultimate responsibility is to our clients' goals and dreams. You can reach us at 251-327-2124 or find us online at gulfcoastfa.com. That's GULF like the Gulf of Mexico, Coast, FA is in financialadvisor.com. Welcome back. Your host, Josh Knoll here, alongside co-host Michelle Lee.
Hello.
So, folks, I'm opinionated. I do have strong opinions at times. I would say a radio show host that isn't probably wouldn't be very interesting, right? And I've paid my profession to offer professional guidance and opinions to my clients. Again, otherwise, what use would I be? So sometimes I feel so strongly about something, I talk about it publicly. I've had various podcasts and radio shows in the past. Sometimes I'll even make some predictions, and I'm a fairly skeptical person, so more often than not, I'm right. But there are times that I swing and miss. So if you want to hear me beat my chest or eat a little crow, let's get at it with Josh's crystal ball and big mouth.
Okay.
What's up first?
All right. So at the beginning of 2023, which seems so long ago,
right.
you predicted that the stock market would be in scratch and claw mode to capture gains, that volatility would continue, and that many investors would make a flight to safety decision with their portfolios. With the recent market downturn wiping out a lot of the year-to-date gains and the market still experiencing occasional significant swings, what are you seeing with your clients, and was your crystal ball right?
Well, so first, yes. It's funny. I'm a fairly optimistic person, I think.
It's annoying sometimes.
Right. I glass is always half full. It's how I roll. But with my own industry, I tend to be a little skeptical. And I think part of that is because I came into an industry, my mid-30s. I was already a fully formed man. I'd already had knucklehead, quote unquote, advisors knocking on my door and telling me a bunch of nonsense. So I came in with a skeptical eye. So I actually have been proven right, but on something that I really was like, oh man, are some of these guys that keep telling us the market's going to, get really beat up, going to be right? Because I'm sick of hearing those guys. Well, here we are.
Well.
So let's do this, listeners. Let's first define what investments are considered safer, or at least compared to equities. Bank CDs, money market funds, annuities, treasuries, and historically, bonds.
All right,
so,
bonds.
Right. So, for example, Michelle, annuities are on pace for their highest sales total ever in 2023. Ever.
Wow.
And then the total amount of capital in money market funds is 5.7
Now, I knew that because we've talked a lot about that.
And so it's increased since we had to talk about it.
It's true.
Now, the market, it did rebound here very recently. And I'm going to tell you, listeners, investors particularly, if you're in this for the long run, the occasional overselling of stocks can present an opportunity to possibly find a long-term discount. Again, I'm not a day trader, no interest. I'm not a trader. I'm an investor. I'm an advisor. We tend to look long-term on our equity position side. The wild card, surprisingly, has been bonds. People are selling off their long-term bonds and they're looking for newer bonds. I'm speaking to you municipal bond holders. You know what I'm talking about right now.
We were just talking to them.
Right, because the general investment community has finally come to grips that rates are going to be higher for longer than expected, which means yields will have upward pressure, which means that bond prices will continue to have downward price pressure. Existing bonds that are at a lower interest rate, particularly long-term bonds. So again, for you folks entering your retirement, or just any of you all that are just have a low risk tolerance, there absolutely has been a flight to safety. And I'll tell you this, listeners, if you do have a damaged bond portfolio, or you're just uncomfortable with your portfolio, or you don't even understand it, we can take a look. So give us a call, 251-327-2124. We'll give you no BS when we talk about what you've got in your existing portfolio.
That's
Good?
right.
All right, what you got next?
Okay. You have stated multiple times that annuity salespeople play too heavy on investors' fears of losing money, and that while these products often have a place with capital preservation with some upside potential and income production, all too often they were sold as a golden ticket type of financial product. We just mentioned that annuity sales are going crazy at our pace for a record sales year in 2023. So obviously the annuity story is resonating with a lot of investors out there. What's your big mouth got to say about that now?
So obviously I was wrong. So let's be honest. Let's just lay it on the table here. Two things. One, I don't remember where I heard it, but there was a guy on the radio saying, imagine if you could go to the casino and you could never lose any money and you could only walk away with
That'd be awesome.
Right? And that's how he was selling a particular type of annuity.
Man.
And it makes me want to throw up in my mouth, right? Now, there is some reasonable math behind some of these annuities because they do have a 0% floor. They do allow you to participate in some of the upside, but they're never going. They have to. Again, we talked about this, Michelle. It is the hammer in search of a nail sales process, right? There needs to be a reason for that placement of that annuity, no matter what type of annuity it is. So that pivots to being honest. I use annuities in our practice because
yes, you do.
They have absolutely historically been proven to do certain things. They can be used for capital preservation. They can be used for income production. And one would argue when you look at all the numbers, there are cases where they do as good or better job than any other option you're going to have. But the main reason I get frustrated with the high-pressure annuity sales pitch is because up until recently, years, the market was doing fine. It didn't have a lot of volatility. Interest rates were low. And the story that they were telling was the sky is falling when the sky wasn't falling. Well, guess what? The sky fell to some degree, especially with the inverted yield curve. And that's all out the window now. I mean, the last 12 months, and it appears it's going to be this way for a while, everything that's happened kind of plays into the annuity story. Whether you're talking multi-year guaranteed annuities, MIGAs, when you can lock in high fives with a reputable American-based company, that's pretty attractive option. Deferred income annuities and Michelle's favorite SPIAs, which is single premium immediate annuities, even FIAs, fixed index annuities. These companies that have a lot of their portfolios in fixed interest, fixed income investments, now they can be a little more generous with their offerings. And there's a lot of attractive things out there. It's a case-by-case thing. It's not hammer in search of a nail. It's not for everybody, but if you got particular needs, whether it's, again, guaranteed interest or it's income production or it's preserving capital with a little bit of upside potential, there's a conversation to be had. 251-327-2124. We got one more?
Yeah. All right. So last one, the gift that keeps on giving. Well, that could be a lot of things. But anyway, okay, stay focused. Financial. On our July 17th episode of Coasting Retirement, you asked the question, is this as good as it gets in regard to fixed interest investments?
Whoops.
Yep. Rates jumped almost immediately. That was still floating in the air in a quote like a cartoon. After that episode, and looky here, it appears that the rates on fixed interest investments have recently jumped again across the board. So I already know that your big fat mouth spoke too soon, but do you care to update us on what you're seeing for interest rate offerings on the fixed rate investments that you can offer to your clients?
All right. So a couple things, Michelle. I'm actually going to pull this up while we're sitting here.
Right? Reference. Yeah. I like it.
So Yeah, so obviously, we've joked about it since then. We were thinking like most, or I was, let's be fair. Yeah, me.
It's about you.
Let me own this. My big mouth, my crystal ball. I was thinking like most retail investors over the years. Again, hey, once things start going a little sour, the Fed's going to come in, drop rates, come save the day on the stock market.
That's right. Dun-dun-dun.
No, they've made it very clear. They were making it clear. We just didn't believe them. That rates are going to be higher for longer until they get this inflation thing down. Again, I think 2% is a little bit of a pipe dream, but so be
wonderful.
it. These guys are brilliant people. They're
for a little while.
I'm sitting here again. We said this before, but I'm throwing rocks at these guys that do this for a living. But anyway, back to my point. You've got MIGA rates, multi-year guarantee annuity rates. 5.75 is one I saw recently is either 5 or 6 year.
Nice.
Again, American-based, A-rated company. I haven't checked bank CD rates because I don't do bank CDs, but I know that they are in the mid to high 5s. And then if you don't like if you want to have more liquidity, then what's going to be with the MIGA, because MIGA is usually going to tie your money up anywhere from 2 to 10 years roughly, and a bank CD 6 months, 12 months longer. If you want more liquidity, you got money market funds out there right now, not money market accounts.
That's right.
A money market account.
That's another episode.
Well, that would be something you get from the bank.
Right.
Money market funds would be something you would buy either on your own or through an advisor or a broker. So, if you desire more liquidity, you got money market funds now paying, 5.25%.
Okay.
That's a Schwab one. If you got $1 million or more, you can get 5.4. These are not, these are guaranteed interest rates. It's not. There's always going to be a little bit of risk with this. These are generally speaking retail products. They do offer some institutional, but for our regular listeners, retail products right now, you can get, call it 5.25 to 5.4. And I'm sure there's even some money market funds out there maybe offering a little bit better. But you can get a really attractive interest rate on something that has not the extreme liquidity of cash sitting in your hand, but it's got pretty good liquidity compared to a bank CD or a MIGA. So now are those rates going to continue forever? No. These are all based on very short duration things, 7-day notes, things like that. But they've been around for a little bit, and it's been pretty attractive for, again, especially if you're entering your retirement. When's the last time you were able to get this type of interest rate on your investments? It's kind of surprising. So, all right.
Surprise.
Well, listeners, I hope you enjoyed a peek behind the curtain on how I form my opinions and my predictions, and more importantly, that I am willing to admit when I'm wrong, which isn't very often, but I'm still willing.
Not.
Right. Now, to our listeners that have more questions about the various investments and topics we discussed in this segment and in this show, we invite you to reach out to us. Call anytime. I do answer the phone.
It's
a weird thing I do. I want to know who's paying attention, who's listening. It's always fun to talk to a listener. 251-327-2124. I sound just like this on the phone, or at least I think I do. Or, again, you can make an appointment and find more information about us on our website, gulfcoastfa.com. GULF, like the Gulf of Mexico, Coast, FA is financialadvisor.com. Folks, that's it for us here this week in Coast and Retirement. I want to give a huge thank you to my lovely co-host, Michelle Lee Melton.
You're most welcome.
So glad to have you back.
Thank you.
Thank you to our awesome radio station, FM Talk 106.5 out of Mobile. Many thanks to the provider of our show music, local band Sloth Racer. And as always, my sincere appreciation for all of you out there that have been listening and joining us on this journey. We'd obviously love to be part of your financial journey as well. Till we talk again next Sunday, have a wonderful and productive week. This has been Coasting in Retirement with Josh Null.
Advisory services offered through Prime Capital Investment Advisors, LLC, a federally registered investment advisor. Prime Capital Investment Advisors, LLC, 6201 College Boulevard, 7th floor, Overland Park, Kansas, 66211. Prime Capital Investment Advisors, LLC, doing business as Prime Capital Wealth Management and Qualified Plan Advisors, and Gulf Coast Financial Advisors are not affiliated. Gulf Coast Financial Advisors, Prime Capital Investment Advisors, Prime Capital Wealth Management, and Qualified Plan Advisors do not provide tax, legal, or accounting advice. This content has been prepared for informational purposes only and is not intended to provide and should not be relied on for tax, legal, or accounting advice. The information provided herein is not a complete analysis of every material fact regarding any strategy. It is intended only to provide insight into the opinions of the author. All information presented is for educational purposes only and is not an offer or solicitation solicitation for the sale or purchase of any securities. Content offers commentary and generalized research, not personalized investment advice, and is for informational purposes only and does not constitute a complete description of our investment services or performance. All investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified legal professional and/or tax professional before implementing any strategy discussed here.